Hey, Mike. What's up? I just did a really long video on bonds, Barry Bonds, and the whole juicing situation, steroids, and the value of baseball players, the profit and loss of the franchises, and I didn't do it about Barry Bonds. I did about bonds, just the financial instrument bonds, not Barry Bonds or Bobby Bonds, Barry's father. But he should be in a Hall of Fame, right? Barry Bonds, because you can't like, the reason you might not let him in the Hall of Fame, well, is because of steroid use. But I mean, I wouldn't say every player uses steroids, after the 1990s. Before the 1990s, it probably wasn't as much. But I would say like 90% use steroids to some degree. Some, like Mark McGuire, used a lot of it. I think his brother's a bodybuilder so he had full access to steroids through his brother. But I think just about anybody, because in order to compete, you have to. You can't compete at that level without steroids. But yeah, I just did a really long video about bonds. I didn't show my face in the video. I'm trying something different, where I'm just kind of using a lot of pictures and stuff like that. But it's bond. I was a bond trader in New York City before I moved to California. So I worked in bonds. But I don't know if you guys want to talk about it. If you want to talk about stocks, that's fine too. But bond prices move inversely to interest rates. So as rates go up, bond prices go down. As bond prices go up, vice versa. So if you bought $1,000 bond, you need to register my losses as on assets. That's one way to do it. There was a pastor. He defrauded his church. It was really interesting. They show the deposition on YouTube, but he was trying to explain. He owned like a $5 million house, a home, and he all the money, all the things he bought was from his church, from people donating through the church. So he had like a Bentley, a stretch limo, and this is what he bought with church money. But I remember in the video he was saying that he didn't own the home; he was leasing the home. But the lawyer who was doing the deposition said, "But why did you list it as an asset on your balance sheet if you don't own it?" So it was kind of funny. He was just kind of he was sweating a lot. It was really funny to watch. What was his name? David something. It's really interesting, actually. So it's almost addictive to watch it. So if you bought a bond, say the face value, say you bought the bond in the primary market, meaning when it was issued. So if you buy the bond when it's issued, that means the coupon, what you pay is the current coupon rate that everybody else is paying. So say it's a 5% coupon, 5% interest, $1,000 bond, so you get $50 each year in interest. So that's the yield, because the yield is just what you receive, your return over how much you paid for the investment. But if interest rates move, because after you buy the bond in the primary market, then the bond is being traded in a secondary market. So if interest rates say go up, so this particular bond, this $1,000 bond, it could be like 6 months later after you bought it. Now this exact same bond is now trading is 5.6%. So if you were to buy the same exact bond today, I'll just put dates in here. So it's always, so yeah, let's say it's January 2024 is, you bought the bond in January 2024, and in July 2024, the same exact bond you can buy for 5.6%. So if you, let's just say it's JP Morgan. It doesn't really matter who issues a bond. So if you bought the bond for $1,000, you would get $56 in interest. So, but you bought the bond in January at a 5%. So no one's going to pay. And you say you want to sell the bond in the secondary market. You want it to. No one's going to pay $1,000 for the bond. Why would they pay $1,000 and receive $50 of interest when they could just go to JP Morgan and give them $1,000 and receive $56 of interest? So since rates went up, the price of your bond went down. So you have to sell your bond for $900 in the open market. And the person who pays $900 for the bond will still get the $50 of interest, but they'll be yielding 5.6%. So the yield has to be the same. No one's going to pay a premium for the stock, for the bond. It makes sense to me, but I feel like when I explain this, it's not clear. But let me know in the comments if it's clear. So let's go back. Say in January 2024, you bought a $1,000 bond with 5% coupon, so you get $50 a year, a 5% yield. This JP Morgan bond, and by the end of the year, rates have come down. So the same exact $1,000 bond, JP Morgan is paying 4.5% interest. So now you can actually sell your bond for more than you paid, because you're getting 5% on the same investment. Somebody else is getting 4.5%. So you could charge $1,100 for your bond, and the person who pays this $1,100 will still get the $50 of interest, because you get paid on the coupon attached to the bond, but your yield is 4.5%, in line with the market. How's the audio? I did a poll. When I watch my videos, the audio seems clear. Maybe is there echo, or is something not clear in audio? I mean, I get it that I'm not like the best presenter. Like everybody's different in that respect. But in terms of like the quality of the microphone, so I don't understand. Maybe it's then people were saying like, you see 22%. 4% said a 1. So I think there's people trolling. If this was higher, I would believe it. But so 22% say it's a 3. The sound quality, it's not great, but I've heard worse. 49%, half of them say it's good. I'm just talking about like if there's echo and things like that. This person said something which I don't really understand. He said, it's not so much the quality of your audio, but the space you're working in. He said, but if it's a space I'm working in, I don't know what that means, but sound absorbent material in front and above will do wonders. Also positioning. I really don't like how in some videos And this person, Blade, is Blade here? Blade is usually Rafi. Thank you, I appreciate it. I see. He's like, get a pop filter if you don't have one. Also, like the comments say, absorption panel. I get absorption panels, which I was thinking of buying. Like I could buy just a throw rug and put on the floor because it's a hardwood floor, and I want to get something for the walls because I guess it's not perfect. It's okay, not the best, but above average. Well, so when you say it's not perfect, like I don't care about perfection because I'm not like if I was recording music and like making a lot of money, of course I would invest like in a sound studio, like a ton of money. But if I can do something to improve it, I wanna. Like I spent $250 on a microphone and $4,000 on a computer because I want to like make it as good as I can. I'm not gonna, I wouldn't drop like 20, 30K into it, but like the computer, I wouldn't have bought a $4,000 computer if I didn't do the channel, but I use it for a lot of other things too. So it wasn't like totally for the channel, but that's really the reason I spent so much in this computer because it edits videos a lot faster. And when you sit there for like 10 hours editing a video, it can't do it. I didn't spend 10 hours. A few times I spent like 6-7 hours editing because if you make a video like beyond an hour, it takes forever to edit by the end. Like in the beginning, when you cut out pieces of it, it's real fast. But if it's like a 90-minute, you tape 90 minutes of content and then you bring it down to 30 minutes. It just takes so long to edit at the end. But this computer, I don't have that problem. It's so fast. I think focus on content. So basically, if you buy a bond, you're hoping interest rates to drop. No, that's not why you buy a bond. You buy a bond as an investment, as a tool to earn income. It's the same thing as if you get a mortgage or a car loan. Although it's a little different because you're acting as the bank when you get a car loan, you're acting as the bank because you're receiving money. You're not investing. But when you buy a bond, it's just a way to it's just a different way to invest. It tends to be more safe than a stock, and it's usually guaranteed income. When you buy a stock, it's not guaranteed. Even if it's stock of a company paying a dividend, it's not guaranteed. But when you buy a bond, like I was saying, say this this was I'm just making it up, but this could make sense. A JP Morgan bond. Because if JP Morgan wants extra money, say they're looking to say they want to, grow. Every company needs money for whatever reason, to grow the business, to get into other aspects, to acquire other companies, to but yeah, if JP Morgan, instead of going to the bank and asking the bank for like a loan and the bank is going to charge them like 8%, JP Morgan will just issue a bond, and people like us, or maybe a hedge fund or a pension fund, a lot of retirement funds buy bonds. So we could buy these JP Morgan bonds, these 5% JP Morgan, and it depends. The percentage. How much interest rate the bond offers. It's dependent on a lot of things, but it's mainly dependent on who's issuing the bond. So JP Morgan may pay 5%, but GameStop, if they needed financing, they issued bonds. No one would buy GameStop 5% because a money market's like 4%. So why would you take the risk of a company that could go bankrupt? So GameStop would have to give like 8% interest to attract investors into the bond. I don't know nothing about audio, but it feels like the audio comes superficial, like it lacks some depth. I don't have a clue what would be the correct technical term. No, I appreciate that. I just think I'm very, I'm kind of monotone. I have a hard time, especially when a camera's in my face, to be real animated. And but the people make a lot of money on YouTube are good presenters. Maybe I'll buy a phone and wall. But just so you know, the bond market is much, much bigger than the stock market. That's how your town was built. That's how your state was built. That's how the country was built, on bonds. Because in order to build a highway, right? In order to build a school, in order to build a hospital, it's expensive. I mean, say your town population was 50,000 when you were born. Now it's 150,000. So, but there's still no. It's hard to get into your town. Say that it takes a while to get into your town from the next town because there's not much bridge access. So say there's a big city 10 miles away, but there's a lot of there's water between you and that city, so you can't get to it unless you drive around a few other towns to get to the bridge in the bigger town next door. So your community that's tripled in size needs a bridge. If you want to Google how much a bridge costs, you can do that. But I'm going to go with like 200 million. Alex, what's up? It could be a lot more. Well, let's see. Upgrading the mic in studio might improve the audio, but it's not bad audio current. Thank you, JB Weld. I really appreciate you. So generous. I think the audio sounds okay when I watch back the videos. I mean, I'm not questioning. I think my delivery could improve, but I get it. I am who I am. I can't really change the way I am. So I'm just kind of keep doing it. I think it's helpful to. I think I'm more comfortable than when I started. I wish they would just. Okay, let's just go with $200 million. I don't listen to earbuds. You do not listen on earbuds. Okay. So your town wants to put up a bridge because across the ocean is say you lived in Maryland. I don't know why I said that, but and you live in it pretty close to Baltimore, but it's hard. You can't get to it because of the water. So you have to kind of drive around to another city to get to the bridge. So it's like a 45-minute drive. But your town wants more access to Baltimore because it's going to benefit your community a lot. Because if you have access to Baltimore, if it's only a 10-minute bridge ride instead of 45 minutes, then house prices will go up because more people will live in your town because it's close to the big city of Baltimore. And then you'll have more access to a big city. So it could lead to more jobs. Possibly your city can grow a little too. So I think you understand like the benefits of having access to a big city. So say it costs $200 million to build a bridge, because there's a lot of stuff you need to do. Most cities don't have a lot of money to just spend. So the main way these things get built is bonds. So your city will issue $200 million worth of bonds. So they might be with $100 minimum. And a lot of people in your town would probably buy a bond, maybe $100. Some people may spend $500. Like there may be 10,000 people who would buy at least the minimum, because it's going to help your town. But let's say the average person in your town spends 500, so that's 5 million. So it's a pretty big gap, right? So what they have to do is just have to kind of like market the bond. That's why you get like a Goldman Sachs to underwrite the bond. That's their job, to not only structure the bond and do the kind of like the financial and like documents, but also I don't know why I threw it. Oh shit, I didn't mention that in my video. No taxes. So they just have to market the bond out to different people, like pension funds, because those kind of like big funds are the ones who usually invest a lot of money. So if your town, what's a town near Baltimore? Rosedale. I'm a music producer. I can improve the audio somewhat if you have a pre-recorded video or something. Really? That's interesting. So let's say Rosedale is a town that needed the $200 million to build a bridge. So the interest rate Rosedale pays is tied to the rating on the city of Rosedale. So if Rosedale was BBB rated, which is about in the middle, they would pay 7.5% interest. So if you bought $500 of the Rosedale bridge bond, you would get each year you would get $37.50. And the way the bond, every bond is structured differently. So when Rosedale pitches the bond, or when Goldman pitches the bond, they say you're going to get to 7.5% forever. And then at any point, you could return your investment. Any point after 10 years, you could return your bond to the city of Rosedale, and they'll give you your principal back. So say after 10 years, you get $37.50 a year for 10 years, and then you decide to just give your bond back. So then Rosedale will give you your $500 back. So that's how they would fund the bridge. But actually what I did, I worked at JP Morgan underwriting bonds, but what I did for the second half of my stint in New York, I worked 7 years at Assured Guarantee. We actually were bond insurance companies. I don't know. I hope this is not boring. Hey, Constantine, how you been? It's been a while. I feel like I haven't seen you. Everybody check out Constantine. He's really, really smart. I'm not just saying that to help him, but he's really good. He knows his stuff really well. So anyways, so I worked at Assured Guarantee. So we insured bonds. So if the Rosedale Bridge bond, because every bond has a name. So the Rosedale Bridge bond, they come to us, Assured Guarantee, and they said, we want you to insure Yeah, we should do another live stream. So Goldman and whoever in the city of Rosedale comes to us or Assure Guarantee and says, we want you to insure a bond. And Assure Guarantee is rated AAA. So to put into context, investments, every year they have to pay $15 million of interest. And these are interest only. Like I said, the way Rosedale is structuring it is saying 10 years interest only. And then you could redeem the bond at any point after 10 years. So you can never redeem it. You could just get your 7.5% in perpetuity. Or you can just, or maybe after 15 years, redeem it and get your principal back. So they would come to Assure Guarantee and said, we want you to wrap our bond. That's what we used to call it, wrapping the bond. So we would take the Rosedale bond and put our AAA rating on top of it. And the reason we do that is because AAA bonds trade at 5%. Because you get a lower interest rate for the safety. That's why like a US government bond is going to only pay you 3%. And a Chinese bond pays you 15%. It's all about the risk. So how does this benefit Rosedale? Well, now Rosedale pays, instead of $15 million a year in interest, they pay $10 million a year in interest. So they save $5 million every year in interest payments. And we charge $2 million premium every year. That's the premium we charge, our annual premium. Every single year, they get hit with $2 million because we're saving them $5 million. That's pretty much how the bond insurance industry worked. And if Rosedale was single A rated, because AAA is the best and AA and single A, they may have to pay 6.75%. So they would pay 3.5 million. So maybe our premium will be lower because we charge premium based on the risk of who we're insuring. If Rosedale was like single C and they paid 16%, we just wouldn't even insure it. It's too risky. So this is now Goldman's going to do all this work because that's why they get their $10 million underwriting fee or whatever it is for helping the city of Rosedale sell the $200 million of bonds, get the bond insurance, and do all that stuff. I really get off on tangents, So anyways, does Goldman rate them? No, Goldman doesn't rate anybody. I mean, they could rate them, but it doesn't mean anything. S&P, Moody's, these are the companies that rate bonds. That's what they do. They've been doing this probably 100 years. So in order for in order to issue the bonds, they need to get the S&P or Moody's rating. They might not have an S&P or Moody's rating, but they have to pay. It's not free. And if S&P rates them BBB, same Moody's might not rate them. So that's what they use. It was a whole controversy. I remember in the subprime, remember in 2007, 8, 9, when the subprime crashed, I always questioned the rating agencies because the rating agencies rated these junk bonds AAA. And that's why people bought them. That's why these big like investment funds bought all these subprime junk bonds, because they were highly rated. So they thought they were low risk, but they actually should have been rated like junk, like single B, triple C, because most of them defaulted. I don't even know why I started talking about this. Who's more reliable? Between S&P and Moody's, I think it's pretty similar. They usually come up with pretty similar ratings. Like S&P AAA looks like that. Moody's, no. Moody's looks like that. I think AA, S&P, like a AA plus for S&P looks like, I haven't looked at this in I think AA1. They look slightly different, but they use the same. So in order for the city of Rosedale to continue flourishing and to maintain a vibrant financial community, they have to get this bridge up so they connect to a bigger city. So they get $200 million in funding, and they only have to pay 5% interest because they got the insurance wrap. But the original question is, why do people buy bonds in the hopes interest rates go up or down? They just buy it as an investment. And if interest rates do go up or down, that's just a function of the external environment. It's the same thing if you buy stock. If you buy $100 for a share of, I don't know what they're trading at, Microsoft, you want it to go up in value, of course. But with a bond, you don't really care, because it's kind of like a guaranteed payment. So you're not going to make a lot of money on a bond. You're just going to get your guaranteed return, your interest payment. So that's why they call bonds fixed income, because it's kind of fixed. You can't double your money on a bond, but you get it's a safety thing instead of putting your money into the money market. But so with the bridge bond, the benefit of this is that they're charging a toll, right? When the bridge is up and running, say in 4 years, I don't know how long it takes to build a bridge. They build the bridge and then they charge, like $9 the toll. So that's how they can pay back the bond payments, the investors on the toll. But there's some bonds, like what if they just built a highway, right? A highway that connected to other highways and there was no toll. It was just a way to like easily get in and out of the town, right? Say they built a highway for $100 million. How would they pay back the bondholders? Does anybody know? I mean, it's pretty much one answer, but how do you pay back the bondholders if you don't get any return? I'll be right back. I'm sure somebody got it, right? Sorry, miss commenting on your. Oh no, Blade, don't worry about it. I get that all the time. Get a better microphone, stuff like that. So yeah, so if the town of Rosedale wanted kind of like more access, and when it was originally built in the 1800s, there was no way to get into the town besides going on like a dirt road for like half hour to get to the next town. There's no highway access. So I'm saying if they wanted to build an add-on to the highway, so they can easily get from Rosedale to other parts of Maryland, they need $100 million, but they're not really getting any funding. Like they're not charging a toll. So it's just pretty much tax dollars. That's how a lot of these like small towns are able to build like schools, hospitals, tax dollars. So there's state taxes and but if you ever see like a country file bankruptcy, or a country, you ever see that like people saying, oh, the state of California once filed bankruptcy, and this a country's default and go bankrupt. I could exactly explain how it. I think they filed bankruptcy in California. It sounds odd, right, when you say a country filed bankruptcy, because it makes sense when you say an individual filed bankruptcy. They lose all their possessions and they have to pay back a lot of money. But how could a town file bankruptcy? Well, if Rosedale built this bridge, right, $200 million bridge, and actually things totally went off the rails, no pun intended. Took them a lot longer to build than they thought, and they didn't get as much benefit as they thought. They thought a lot of people would use that bridge to go into Baltimore and pay the $9 toll, and people didn't want to pay the $9 toll. They'd rather drive an extra half hour to the next town where there's no toll. So it kind of backfired, this whole idea. And Rosedale could not pay back the investors. So after 10 years, the people who bought bonds wanted their money back. They did get their interest payment, the 5% interest payment, but Rosedale didn't have the money to give back. So Rosedale defaulted on this bond. So they would have to file bankruptcy if they default on a bond. That's like the definition of bankruptcy. The only way you could file bankruptcy is when you can't pay back the principal or interest payments on your debt. Like if you can't pay your mortgage anymore, you may be forced into bankruptcy. If you're from Argentina, yeah, defaulting doesn't sound odd at all. I remember when I went to Argentina in 2012. It's so much inflation in Argentina. They're always devaluing the peso. I don't know why, but they always have problems, monetary problems. Inverse leverage mean on a bond ETF. I mean, it's pretty simple, actually. Okay, so so bond prices move inversely to interest rates. So when interest rates go up, bond prices go down, right? that's kind of like a known thing, but I'll show you. Like, remember when I showed you earlier, if you bought this $1,000 bond, this JP Morgan $1,000 bond, and they're paying you 5% coupon, so you get $50 in interest every year. That's your yield, 5%. But if rates go up, say interest rates are 5.6%, the price of your bond goes down to 900. And if rates go down, say to 4.5% from 5%, then the price of your bond goes up. And that's how bond prices and interest rates move inversely. It's the same thing as when you have a mortgage loan, a mortgage on your home, or a car loan. Say you get a car loan for $10,000, and you have to pay 8% interest. So you have to pay $800 a year for, say, 5 years, and then at the end of 5 years, you have to pay back the principal. But if this might be harder because in this case, you're acting as a bank. Maybe I should just leave it as is. So yeah, so bond prices move inversely to interest rates, and these ETFs use leverage to fund the to buy bonds. So they're levering their investment, but it's inverse. It's inverse based on the interest rates. I'll see if there's a more eloquent way to, because no one's ever asked me that, but sometimes I have to say something 5 times before I could explain it clearly. Inverse leverage. Let's see if they explain it the same way I do. So the way this website, leveraged inverse ETFs. So they use the same concept as leverage products, meaning leverage just means you're taking on debt to grow. So say you bought a home, say your primary home, $500,000. Home, and then you took a loan you took a $350,000 loan to buy your home. So you have to just pay the principal and interest payments. This is your main home. And it doesn't matter what happens to the price of the home, whether it goes up or down. You still have to pay back the loan. I mean, you want it to go up, of course, but let's just say pretend you paid $500,000, or you buy a $500,000 home, you put $150,000 out of your pocket, you get the loan from the bank to get the home, and let's just pretend the home doubles in 5 years in price. So you're really happy. You're like, wow, I doubled. So you're looking to invest. So across the street, you want to buy that home across the street, and it's not as nice as yours. Yours is $1 million. So across the street, it's $800,000. So you get a loan for $560,000. The rest comes out of your pocket, and then you just rent out the home, and hopefully the rent you charge, hopefully that covers the principal interest payments. So that's just leverage. You just keep taking on debt to acquire more assets. if interest rates go up, your bond becomes less attractive because investors can get a better return. Exactly, Rafi. That's a great way to say it. That's exactly. They would just go somewhere else. So leverage inverse ETFs use the same concept as leverage products and aim to deliver a magnified return when the market is falling. So that's what you're doing in here. You want to like keep, investment one, and then if you're happy, say you're charging $6,000 rent, and you pay the bank, $5,000 for the P&I, the principal and interest. So you're happy with the way this is working out. So another home on your street opens up. That's also $800,000. So you buy that home, and you keep doing this. So you're levering up. I mean, you're doing well because the home prices are going up, but there's risk, of course, because what if the home prices go down? Or even worse, what if your tenant moves out and trashes the home? So you have to pay $50,000 to clean a home up, and 6 months without a tenant. So all this is great as long as you can service the debt. But once that happens, so it's just levering up. For example, if the S&P has declined 2% a day, 2x inversed. So it's just kind of it's just buying on debt, and the reason it's inverse is because it moves the opposite of interest rates. I assume the same goes for stocks that pay a dividend. The price of stock could rise. No. Stocks don't move inversely to interest rates. Stocks move with interest rates. Generally. But actually, no, I'll take that back. There's no relationship, at least the way I think about it, between stocks and interest rates. Because stocks don't have to pay a fixed. The reason interest rates affect bonds is because of the fixed interest payment you pay towards the bonds. If it was a variable interest rate bond, it wouldn't move much in price. But it's kind of like it's the same thing as if a bond is just like a car loan. So say you borrow $10,000 from the bank, and it's a 7% car loan. So you have to pay 10,000 times 7. So you have to pay 700. For 3 straight years. So let's just go more. Let's do 5 years. It's easier to, let's say you took a car loan for $10K. You wanted to buy a used car, and the bank is charging you 7%. So you have to pay them $700 a year. And you have access to the car, and hopefully you can pay the $10,000 back after but what if rates go down, right? Say the rate for a car loan is 6% because the Fed cut the interest rates. Now it's not as attractive anymore. You're paying 7%, and your friend, say, borrowed $10,000 at a bank, and he's paying 6%. And it's even worse. A few months later, they cut again, and now it's down to 5%. The rates. So you probably want to refinance. I assume the same goes to stocks, but if you're looking at yield between a stock, dividend, or a bond pays. Well, the thing is with the reason bonds are highly sensitive to interest rates is because I'm just assuming it's a fixed rate bond, because if it's variable, it doesn't make sense. Because 7% fixed rate, you're going to get that 7% regardless of what happens. So maybe this year 7% is amazing, but 10 years from now, who knows? But a stock, a dividend is not fixed. So a dividend it generally moves with how profitable the company is. So does that make sense? Like with this example, if you paid 7% for a car loan, it would suck if the rates came down to 5%, because you don't want to overpay. But if it's adjustable rate car loan, so it moves with the market, it doesn't matter, right? Same thing with a dividend. Dividends are generally, it's not adjusted towards interest rates, but it's adjustable towards the company's earnings. So if the company's doing well, they'll raise their dividend or lower their dividend. I think banks and insurance companies, interest rates, their stocks, prices. But I could be wrong. I just never thought of interest rates. When interest rates are rising, both businesses and consumers will cut back on spending. This will cause earnings to fall and stock prices to drop. On the other hand, when interest rates have fallen significantly, consumers and businesses will increase spending. I mean, that makes some sense, but there's no direct correlation. When the Fed cuts interest rates, it causes the stock market to go up. When the Fed raises interest rates, it causes the stock market, but there's no guarantee as to how the market will react to any given rate change. I guess as a general rule, we all know that when the Fed does cut interest rates, generally the stock market goes up. I mean, because actually investors, sometimes the market goes up just if there's an idea that the Fed will cut rates in a few months. So I guess indirectly it moves opposite interest rates, but there's no direct correlation. With bonds, it's a direct correlation. With fixed rate bonds, a business that has to borrow for capital can borrow for less. Yeah, if it's a company has a ton of debt like AT&T, they're going to be highly affected by high interest rates. But like a company like Apple or Microsoft, they have so much cash. If they wanted to, they could pay off all their debt. They're not really as sensitive to but interest rates affect companies differently. Like a tech company is not nearly as affected by interest rates as a REIT, or a bank is much more affected by interest rate changes than a grocery store. Lower rates would make it easier to leverage the market. You have lower costs. Yeah, generally lower rates are better for growth. Generally. But remember we kept rates like under 1% for a long time, at some point it could backfire on you. So it's kind of like you can't predict how the market's going to move, whether interest rates go up or down, or whether jobs, there's people are out of jobs, or people are highly like there's no way to guarantee. But like with a bond that pays a fixed interest, there is a guaranteed movement. And I think you said it well too. Like if if this JP Morgan bond was giving you a 5% yield, and now it's the same bond a few months later is 5.6%, why would anybody want your $1,000 bond that pays 5%? They could just go to JP Morgan and get a $1,000 bond, 5.6%. So that's why you have to charge $900 to sell your bond to compensate for the lower interest rate. Yeah, but inflation definitely puts a monkey wrench in everything. If you keep rates real low, like we did. But it's really confusing because you always see these kind of like explanations, and I'm not saying they're wrong, but there's so many variations to everything. Like I always think, like, even if you predict a company is gonna start making more money and doing well, but the stock goes down, and then the opposite, like you think, okay, I'm gonna sell my CVS stock because I think they're going to really struggle financially. And they do struggle financially, and the stock goes way up because the price of the stock would like these kind of like market these kind of things that happen in the market, these macro events may have been built into the stock. Like with the S&P 500, investors were expecting rate cuts this year. So we were expecting like 3 or 4 rate cuts. So the S&P 500 was 470. Now it's 560. So the market's up 19% year to date. And it wasn't because we cut rates. It was because we expected to cut rates. So it's already built in. When we do cut rates, it actually come down instead of going up because it was already priced into everything. That's one of the more confusing things about the stock market is you can't invest based off of what you think will happen. You have to kind of invest on where the price of the stock is, not so much like when like Tesla is a good example. I was telling my friend for a long time to get rid of Tesla. Like, Tesla was losing a ton of money, and like every year they lost a ton of money until like maybe 2018, 2019, they started making a little bit. And once they started becoming profitable, let me see if this is a good example, I think. So this is Tesla's earnings since 2014. This makes it hard to see, but buy on rumor, sell on news. That's almost what you have to do. Okay. So obviously before 2014, they were losing a lot of money, but you can see how this green line is their net loss. So they lost money up through the beginning of 2020. And the stock, I mean, it definitely moved up through 2020. But their peak, you see, they peaked. This is their stock price. It peaked at 400 in the end of 2021. So right here is their peak in stock price, which is they became profitable in 2021 for the first time. But you can see the stock price peaked when they just started becoming profitable. They didn't really make much money at that point. They probably still had a lot of losses if you summed up everything from the past. But I don't know if that's the peak, but you could see they were still growing their profits. And actually, they're making pretty good money. It's come down the past quarter or two, but it's still, they're making good money. But you can see the stock went down. It actually went down from, they peaked here when they just became profitable, and they went from about 1 billion in profit to 15 billion in profit. And instead of the stock going up, it went down like 50%. They went up 16x in terms of profit, but the stock went down 50%. Tesla isn't a rational example. They're still up despite forecasting low earnings. No, but a lot of companies are like this. Assuming a company becomes profitable at some point, most companies just never become profitable. And the stock does go up and down, but eventually it just goes away. But if it's any company that has a long history, like an Amazon, a Tesla, that's been around a long time, that people have bid the stock up, it's not correlated to profits. There is correlation up to a certain point, but when it hit 400 here, they were already assuming they would be a $20 billion net income. So at some point, people taking their profits. But you could look at a lot of companies, but 95% of the companies out there, you'll see the stock going shooting up and then coming down, and they're almost never profitable. But if a company does actually grow into their market cap, like they kind of did, they got, in terms of profits, they're getting close to justifying their market cap. It doesn't move together. I mean, pick another company. We could do the same kind of thing. People say that all the time. Their earnings are great. Like the past 2 years, they reported amazing earnings, but the stock keeps coming down because you bought it just at a terrible time. Just because their profits were kind of low, it doesn't mean the stock price will go up. It's all based on if all that was built into the stock price. It was already so overvalued when you bought it. Because if you waited for Tesla to become profitable, you had to wait until the beginning of 2020 when it started to go up. So that would have actually worked out for you. But usually it's a stock price is so high, and sometimes they're not even profitable at all. Yeah, because once you see this, like a company losing money and they finally become profitable, you expect growth to magnify. Like year after year, it's going to keep growing. And in their case, they did well in terms of growth. But most of it, this growth up here is already built in way before they get there. So if you want to make a lot of money with a stock, you can't wait for them to grow and become real profitable. You have to kind of do it before. Yeah, I don't like buying a stock before profitability. My favorite stocks to buy is is when there's a big pullback. Like Meta's a good example. Like you knew they were really profitable for many years now, right? But there was never an entry point. They finally dropped a lot. But I did pick up Netflix. I wanted to buy Netflix for a long time, but it was just too expensive. And so that when they hit 700, so I wanted to buy them in 2012. I wanted to buy it, but that's when I was opening my business, so I didn't. It was 700, so obviously I'm not going to buy it at 700. Then it came down to 640. The following month, it came down to 600. Then the following month, 427. So I did pick it up at 388 in January 2022, which I thought was a good entry point because it was 700. It wasn't quite down 50% from the peak. And then 2 months later, I'm down 50%. So I was a little annoyed because it wasn't the best timing, but now I'm happy. I'm up like 70%. Obviously, I don't have an infinite amount of money, so I can't just keep buying down. I mean, of course, I wish I did in this case. So yeah, that's what I like, investing in stocks, good companies that are discounted. So this was an example. Disney, I'm not doing as well. I mean, I timed a lot better. For Disney, yeah, in August 2023, so Disney, it peaked at 200 in 2021. That was the high, right? Yeah, peaked in 200 at 2021. And August 23, I got it at 86, which I thought was a great price for Disney because it's pretty close to that at the COVID bottom. But that was back, 10, it is like a 10-year low almost. So I caught it almost, I mean, it came down to 80, I think. So I didn't catch the very bottom, but pretty close. So I was really happy up here. But now I'm like, it might come back down to 80 or 70. So who knows? Like, you just got to wait it out. And hopefully it rebounds. Baidu recently caused the price was low. Then they announced their self-driving taxi plans, and the stock was up 20%. Yeah, Baidu is really undervalued. $35 billion. Sheesh. So it was like 120 billion, I guess, the peak. So it's at the end of 2022 was a low. It was down to 80. So it's trading right now what it traded in 2010. So 14 years ago. And they're not like getting smaller, they're just growing. They're still profitable. Look how much free cash flow they have, like $4 billion US dollars. They're look at that. Their forward PE is 10. Do they pay a dividend? They don't pay a dividend. And any stock we should they're always undervalued, Chinese stocks, because it's just the risk return. So yeah, so we did the bonds. I did some of my video calculating the yield to maturity. This is a zero coupon bond. So zero coupon bonds don't pay interest, but you get you buy the bond at a discount. That's the interest. You do get interest at the very end. It's like it's implied interest. It's kind of like if your friend said, can I have $1,000? And you said, well, what are you going to give me? Give me what interest payment you're going to pay me? And you tell him, your friend, give me $100 a year until you pay it back. And he said, no, how about this? I'll give you $1,200 in 2 years, which is kind of like the same thing you said. That's a zero coupon bond. You don't receive any interest payments. It's paid at the end. So is there any stocks anybody thinks look interesting? So the top gainers: Inspire Veterinary Partners, Crown LNG. Look. Packard Shop. Yeah, Packard. I remember on Semiconductor. Hope I can do a video tomorrow. I'm losing my voice. PACCAR. Do they have EVs too, PACCAR, or just regular? 4, 4, 4. $134. What do my videos say? Actually, it's right here, right? $140. My video is $140. I'm $134. It's pretty close, right? So you think the market's going to skyrocket if Trump gets elected? Should they go through the moon? All right, they own DAF, Kenworth, and Peterbilt. Those are one of the bigger truck companies in the world. They look pretty good, right? They have a good and they pay a nice dividend. They pay these really big dividends once a year. On semiconductor. Yeah, I remember looking at them before. 77.33. Everybody wants a semiconductor stock since NVIDIA. Everybody's trying to find the next NVIDIA. Intel is going to be the next NVIDIA, right? I think that's a lot of people thinking that. I don't know about like how focused they are in the EV space. I mean the AI space. 62. 69. This is slow. Okay, in May 2022, they were trading at 56. I was 65. That's not bad. It's 77. And I'm pretty close to... I'm 69 today. They're trading at 77. And I predicted 65. That's pretty good, right? That's within reason. They actually blew past my prediction. Shopify. That's an exciting company, right? Shopify. What's so Nvidia went up like 50,000%. Why does a company like On Semiconductor not even double? They're in Arizona. On Semi ranked among the world top 20 semiconductor sales leaders. Didn't like Intel try to acquire them, or was that somebody else they tried to acquire? That was another semiconductor company, right? They tried to acquire. I don't know. Do you guys like semiconductor companies? I just think they're just too volatile. I mean, I missed out on the big run up, but on long-term basis, they're usually not the best investments. Isn't there a semiconductor index? Indie Semiconductor. That's different. The mega caps needed to build data centers to tell investors they are on the AI bandwagon. Nvidia was ready to fill the bill. Yeah, Nvidia is perfectly set up. Will it last? I just can't see it. I just can't see it. I think they're going to still be a pretty big company, but I just can't see them growing like to 5 trillion. Like an Apple, Microsoft, I see it. It makes sense. I just can't imagine Nvidia. Because I don't think a semiconductor is not like a. I think of it as kind of like a commodity almost. I know it's not exactly like commodity, but I think of it as like. I mean, Nvidia did a good job making their semiconductors really stand out and better than everybody else's. But I just can't see it like lasting, because it's like if you sell the best like steak, and you have a restaurant that has the best steak, like they'll definitely do better than the average steakhouse, but it's almost like a product, like it's too easy to replicate. I know it's different, and having the best gasoline fuel, it doesn't really make you're not going to make much more money than next gas station. They're almost identical products. They're relying on Taiwan Semiconductor. Intel potentially can have more control over pricing and process in future. On Semi. I'll be right back. Winter's coming. We lost a lot of people. Semiconductor industry is highly cyclical and subject to shifts in the demand. Because the only way for you to like have a, not the only way, but like the easiest path to becoming $1 trillion company and possibly 5-10 trillion is you have to have so many people using your products. Like that's how Apple and Microsoft did it. Like there's so many people that want to buy their products. So many people have iPhones or Apple products, and you can't just sell a product once. Like you have to have, like that's the great thing about Microsoft and Apple and some other companies is they constantly, you have to buy the products all the time. So if you sell like something, like if you sell bowling balls, for instance, like there's just a tiny population of people go bowling enough to buy their own bowling ball. And then if you buy it, you're probably not going to buy it every single year. You need a product that, like if you sell, toothpaste and you sell like shaving cream, those products you have to buy all the time, like every, few months maybe. Or if it's some product you have to buy every month. But it's like commodity. There's nothing that special. Like you don't have to have this company's shaving cream. But phones are something like Apple has made people love their phones, and you do have to buy, maybe not that often phones, but maybe every 3-4 years. But they have so many other products, so many add-ons. And Microsoft, they did a good job. I think Meta reaches so many people, especially the ad space. But I've been saying somebody that I think it may take over everybody. And I'm finally up on my investment because Amazon. I bought Amazon and when did I buy Amazon? In May 2020. I put a lot into Amazon in May 2020 at 112. And I was up a good amount. Within a year, I was up like 50%. And then it came down real low. I was down like 30-40%. But it's finally yeah, the NVIDIA gaming, yes. They've always had and I never connected semiconductor chips for gaming to semiconductor chips for like everything else. But they've done it. But it's like if you're the best in the gaming market, which is a great market, I'm not saying gaming is a huge industry, but it's hard to be $1 trillion company unless you reach like an enormous amount of people. And that's what these companies like Netflix, they reach so many people, and Amazon, they reach so many people. But the video game market, is a subset of like of the amount of people like these giant companies reach. But I don't know. I keep losing people. I should stop talking about this. Evaluation AB. Yeah, Swedish online boutique for gambling. Quite a few super investors are taking positions saying it could be a 100-bagger. Yeah, that's Evolution AB. It trades in Stockholm. I wonder if it sounds familiar. They do trade on the pink sheets. 100. That's expensive for pink sheets. $110 a share. 23 billion market cap. So a decent sized company. I guess I never did it. They pay a 2.5% dividend. Yeah, if the AB is after the name, I think it's always Swedish, right? Yeah, Aktiebolag. So it's always going to be. I think like PLC is always British. When a company is abbreviated AB in Sweden, so if it's capital AB, it's a Swedish company. If it's capital A small b, it's Finnish. That's I didn't know about that. It's Finnish if it's capital A small b. So this is in Swedish krona. Krona, I think it's. So it's 16.59 and peak in 2021. It was cut in half. And still trading a lot lower in 2021. Well, they're really growing. They must be acquiring companies. It's a lot of growth. I mean, what am I doing? Oh, so they use euros in Sweden, right? Yeah. They seem overvalued. I'm way off. I'm not sure why. They're only trading at 16 times forward PE. Yeah, I don't know. It's hard to. Yeah, I'm not. I don't know about 100 bagger, but if it's 100, it's not that cheap. It's 23 billion. So it would have to be 2.3 trillion market cap to be 100 bagger. So I don't think that's possible. But I mean, a 5 bagger, it could be 100 billion, I guess, market cap. If it was like 200 million market cap, I could see maybe 100 bagger. I feel like something's wrong with my formula. I'm not. I'm so far off. I don't know. What's Bitcoin is coming back up, right? It was 70 recently, right? It was 70 in March. So 4 months ago, 70. But didn't almost hit 70 at one point in the past? Okay, 65, 66. Does anybody own like a lot of Bitcoin, like more than like $10,000? Yeah, Dogecoin. It's down a lot. Maybe year to date it's up. It must be up. No, I think it's probably down year to. Okay, it's up 24% Dogecoin. Bitcoin's up 41%. Isn't that like the S&P 500? Isn't that up? I think actually it moves with S&P 500 with Bitcoin. Maybe not quite, but yeah, S&P is up 40% year to date. Bitcoin 20%. So it's crushing Bitcoin. Even in the past 5 years, Bitcoin is up 86%. S&P almost 500%. Could you imagine it? Oh no, I'm doing the opposite. I knew something was wrong. So yeah, Bitcoin's up 41%. ADA. Okay, Bitcoin's up 40% year to date. S&P 18%. In the past year, Bitcoin is up 88%. In 2 years, it's really performed well. And since 2015, it's up 26,000%. Did anybody watch that guy, Dogecoin Millionaire? The guy, he had like over 1 million of Dogecoin, and then he kept it, and it went down to like pretty much his original investment, like 150,000. Now it's back up. So in 2022, so April 2021 is when it really started to take off. And then Elon went on SNL in May 2021. And that's when it peaked over 70 cents. I've heard people say that Bitcoin goes up. Bitcoin goes up with something called the liquidity cycle. Liquidity cycle. That refers to fluctuation in availability of and cost of money in economy. I guess that's like most things in life. Liquidity cycle is the fluctuation in availability and cost of money in an economy over time. It operates through alternating periods of expansion, which encourages more borrowing, driving the economy to grow, and contraction, which encourages more saving. So I guess, yeah, so the more money, the more disposable income, I guess, we have, the more likely we're going to buy something, I guess, like Bitcoin or housing. Generally, we always spend money no matter what. But if we have more disposable income, I guess certain investments are really good. Like, I guess real estate or things like jewelry, things do. Like if I got, like if my boss said, it's a great year, he has $100,000. So I'm probably more likely to buy certain things if that happened, like, than if that didn't happen. Like I'm gonna always spend on like, working out at the gym. I'm gonna always spend food. Obviously, certain expenses you have to pay. Maybe go on a vacation a year. But if you got a big chunk of money in one shot, like somebody died and left you money, what would you probably buy? That's kind of like, I guess, liquidity cycle, right? But that's hard because I think a lot of people, especially in this group, are more likely to spend it wisely. You have to think of somebody who doesn't have a lot of money. What would they do if you gave them a check for $10,000? They'd probably get a new car, maybe, or maybe rent a better apartment if they were renting. The Fed is on a cycle of pumping liquidity into the economy every 4 years. Well, yeah, they do pump a lot of money. And I question that. I think, all this money they're putting into, all this debt, is it going to lead to like a big problem at some point. But it's I don't think so. And I know it doesn't sound great when you have, so much debt. But they control all the money, though. So if it was you that kept borrowing, and like you kept like taking on loans, and you kept buying, doing things that aren't probably the best of money, like you were buying new cars, you were going on vacations. So at some point, it's going to catch up to you. But if you were like if you control this big conglomerate of a business where you had access to all this money, like it's just like they have just too much at their disposal for me to be concerned. And I don't think they're spending like just throwing money away either. But it does seem like that sometimes, right? This is so 34 trillion in debt. Okay, here we go. Here's the debt by it's hard to it's hard to look at it, all right? No, I don't worry about the stock market, or I'll tell you why I don't worry about it. So we had 17 billion of debt in 1929. It was 137 billion in 1943, the first time over 100. $1.1 trillion in 82, the first time over a trillion. Let's see. So this is the percentage. It grew 90% from 42 to 43. I guess the World War II. So you see, it usually grows. Okay, so I'm gonna put if it's high debt, if it's over 20%, if debt went up over 20% from the prior year, I put high. So World War II, I think that's why it's all these highs to fund the war. And then you can see the next 50 years, it never broke through 20% in a year. 1983, okay. The jobless rate 10.8%. It's not even that. To tell you the truth, it's really not growing that much as I thought. Okay, there was some like 2000, the Great Recession, debt increased in 2008 11%, then 19%, then 14%. And COVID, it went up 19%. But outside of those, it doesn't grow that much more than. It grows a little more than inflation, but so it grows at 9% a year on average, our debt, which is a little more than inflation. It's not that crazy. It makes me feel better seeing this. Actually, I'm seeing the percent growth by decade. Things are just getting so much more expensive than they used to be. So that has a lot to do with it. And the reason like the stock market is up so much and housing is so expensive is it just costs a lot more money than it used to. Everything's just so much more expensive. I'm glad I did this. This actually makes me feel a lot better. Do you worry about stock market? So in the okay. So in the 1930s, debt increased 150%. It was 16 billion to start the 1930s. I guess I could calculate the end. So it's not that bad, actually. So the whole decade for 10 years, it went up 150%. So that's like, 12, 13% a year on average. So it started 16 billion in 1930 and it ended at 43 billion in 1940. So for the decade of the 40s, it went up the most, almost 500%. It went from 40 billion to 250 billion. Then the next decade, it went up the least, 11%. The worst decade was the 80s. Well, not I guess the 40s were the worst. In the 80s, it went from 900 million to 3.2 trillion. Reaganomics. Everybody's bashing. It's you have to look at things as a percentage. You can't look at things in nominal values. You can't say, I make $50,000 a year and my great grandfather made $1,200 a year. So I'm doing so much better than my great grandfather. You can't look at things that way. The 2000s decade was not good. It went up 110%. But we're starting with such a high base. So it's just you can't bring it down, debt. This is interesting, right? It's not that bad. So far we're not even halfway through the decade and we're up 23%. So it's actually not that bad. We're probably in line with 2010s. That went up 68%. But besides the 50s and 60s, every single decade, our debt grows quite a bit. Why did it grow so much in the 80s? It was Reagan. Reagan was the president pretty much the whole time. Oh, the 87 market crash. I don't know. The savings and loan crisis. This is why I don't think the market's overpriced, because you can't look at the market cap. That's not a good indicator of. It's the PE you got to look at, because you can't say I'm making $50,000 a year, and my father only made $10,000 a year when he was my age, so I'm overpaid. But you could look at the PE ratio if you want to compare. Besides 2009, when it was just a crazy high PE ratio, and companies are just making a lot of money. The PE ratio is 26 for the S&P 500. Sure, it was higher than the 50s, 60s, 70s, but it was different times back then. There was much less liquidity, less people investing in the market. Now you just have, I think, the days of the PE below 20, it's not going to happen. It's not like it was. It's a different economy than, and it's almost a different country than it was in the 40s, 50s, and 60s. There's just so much money, and we've evolved so much as a society. And we're still the largest country in the world, and the world's evolved a lot of countries. So based on this, if we're overvalued now, then we've been overvalued, because we're kind of averaging 25 probably since 1990. Right. But we don't have high PE ratio. That's what I'm trying to say. We're at 26, which is about the PE ratio for the past 25 years. It's probably averaged about 26. The only time it was obvious was the Great Recession in 2007-8. That was when it was extremely overvalued. But besides that point, it's not that high. We got high in 2001, and there was a correction, and it came down to 17. I think it's too much of a correction, but I don't think I could say it's a little overvalued. But I don't think it's it's really I don't think we're gonna be averaging, a 15 PE for like ever again. Maybe it'll happen like for a year or two, but it won't be like for a decade or 2-3 decades. We're gonna be averaging. I mean, we're averaging almost a 10 PE some decades. In the 70s, we're averaging 10. That's just my theory. I mean, I just don't see it. We've grown so much. The U.S. Everybody's grown so much because we've gotten so much more advanced than we in the early 1900s, in the mid 1900s. It's so much more advanced with computers, so we get a lot more done, just a lot more money. So my theory is we're never gonna get into a recession or depression ever again. The U.S. I don't think it'll ever get to the point. I mean, there will be a COVID type thing where something, stirs up the whole U.S. or the world, and then something crazy happens. But it's going to be short-lived. When there's a correction like COVID, it'll be a really short-lived correction, and it'll come right back. I don't think we're ever going to be up to a point where we're at a 1 year plus recession like it was in 2008 or the 1920s. I don't think it ever happened ever again. Well, because the market keeps going up. So it's the assumption is if it keeps going up, it's going to be a big crash because it can't go up forever. But I think it's kind of in line with the valuations, with how companies are doing in terms of profits. So I don't think it's that crazy. If it was like in the mid to high 30s, I would expect a pretty big pullback. But right now, yeah, I think it was in the mid 30s and right after COVID started, and we did get more of a pullback. I remember 2022 was a rough year. 2021, 2022, but I think if you see the PE get above 30, it's definitely clickbait. I would listen to people like Tom Lee, like kind of respected economists and investing, and either who do you guys listen to? Who do you respect? I mean, I like Tom Lee, Warren Buffett. Like, who do you listen to that you really respect? Yeah, I wouldn't listen to anybody on YouTube. I don't respect, because it's definitely about views. It's not about. It's like watching reality TV. It's all kind of staged. So it's not real life. People are just doing things for kind of the extreme. Well, yeah, that's true. About half the growth is from like 10 companies, but that's just how it is. When you like if you were to like look at like any community, like if you took any country, like if there was like 100 million people in a country, and you just looked at the top 1,000 people, the 1,000 richest people in that country, I bet you they make up like a third of the payroll and taxes. It's just they have so much weight. Like Nvidia is a little different, but I mean when Apple goes from like 3 trillion to 3.4 trillion, and they only went up 11%, 3 to 3.4, but that's a 400 billion market cap. That's like, so many companies, even if they doubled, even if 1,000 companies doubled in price, it wouldn't be worth 400 billion market cap. Yeah, I don't. It's always been that way. I mean, maybe it's a little more concentrated than it was. I don't know, but just the big companies, or the big of anything, just make up more of the portfolio. But it's not like it's a bad thing, because those companies employ so many people, and they spend, they spend a lot. They spend on, they support a lot of smaller companies because they buy a lot of things. So, I mean, they're not just, it's not like they're just keeping the money to themselves. So, but that's why I invest in a lot of these bigger companies, because that's where the growth is. Every time I try to time really a micro cap stock, I lose like most of my investment. If I try to so I just put money into like these Berkshire Hathaway or something. I know it's hard to find. I think so. It's really hard because he was able to analyze the market before most people could figure it out. So he was making great returns because he understood the market so well. But now there's so many people who understand it so well, and computers. So I don't think you're going to get that much of an advantage trying to do amazing due diligence. I don't think I can. I mean, Noble Corp. $6.5. It's okay size. It's not that small, I guess. Stay above $1 billion, because anytime you go below $1 billion, it's almost impossible, it seems. But yeah, I know how you're feeling about the market being overvalued and things like that. I mean, in 2022, I was getting killed. My portfolio I couldn't even look at it. I was down like 40%. I mean, it was painful, but just stick with it. I knew it was going to come back. I just wish I had more money to put into the market to benefit from the growth. But I did benefit a lot the past year or so. I'm up I doubled my portfolio in about a year. So mainly because of Meta. I mean, well, look at this company, Noble. This looks really good. So these are the kind of gems we gotta find. Companies like this. Okay, offshore drilling contractor. It has 24 rigs. Okay, about a quarter of their revenue is Exxon, so they work with the super majors. Half their revenue is with Exxon and Shell. Yeah, this is a good stock. Noble Corp. I should do a video on them. I wonder if they probably move with the price of oil, I would think, right? I guess not. In the past year, they've moved oil, but they're up a lot. They're up 79% in the past 2 years. I wonder what. VIP Shop, yeah, I looked at them. They're pretty good. I think they'll do well once Chinese economy. Okay, so it's a good stream. 2.5 hours. So thanks for joining. I gotta edit my bond video, the bond market, how to understand bonds. Hope it gets a lot of views. But okay, yeah, thanks for coming on, and I'll probably see you tomorrow, possibly. Okay, have a good night.